Are you looking for that perfect dividend paying stocks to add to your portfolio? Well, rather than doing a ton of research and having to go through different dividend paying stocks one by one, comparing them based on their fundamentals and other consideration, you could easily invest in a high quality dividend paying Canadian ETF or exchange traded funds. ETFs are baskets of companies, high quality ones put together into one single fund that allow you to not only get more diversified exposure at a low cost, but also have the option of collect your juicy dividend distribution income every single month, depending on the funds that you choose. And in this video, we're going to be introducing to you the top 6 Canadian dividend paying ETF that allow you to collect monthly dividend distributions. We've listed these ETFs from the lowest fee to the highest, and at the end, I will compare them more closely and let you know which one is my favorite pick. The first one to review is iShares Core MSCI Canadian Quality Dividend Index ETF. It's available with ticker symbol XDIV. You see here, it was last traded at the price of $25.10. Year to date, this ETF is up by 7%. Through XDIV, you're getting exposure to 18 different high quality Canadian dividend paying stocks. Looking at the past performance for XDIV, its 3-year annualized return is showing to be 16.8%. Its 5-year annualized return is at 8.5%, and its annualized return since inception is 8.1%. When we mention annualized, we are talking about their return for this fund over those time period, averaged over that specific time. So for example, let's say if the fund has been around for 5 years and overall it has returned a total of 50% cumulative, its annualized return over those 5 years would be equal to 10%, just to give you an example. With XDIV, this fund hasn't been around for the long period of time. It's been only incepted back in June of 2017, so about 6 years ago. It does allow you to take advantage of the dividend reinvestment plan, or DREP. We're going to take a closer look at more specifically its fees and holdings. When it comes to the management expense ratio, or MER, that we use commonly to compare different ETFs, we are looking at a fee of only 0.11%, which is quite low in a grand scheme of things, especially as you are going to compare this with the rest of those high quality Canadian dividend paying ETFs that we are going to have and showcase to you. It's in fact the lowest of them of all. It has 18 different holdings, as we talked about. Looking at these holdings across the board, the biggest holding is to Suncor Energy with about 9.5% exposure. Next, we have Sun Life Financials. Then we have Bank of Nova Scotia, Manulife, Fortis, Royal Bank of Canada, Toronto Dominion Bank, Pembina Pipelines, Emera, TELUS. Then we have Great West Life, Canadian Tire, Keyera, London Mining, Quebecor Inc. Class B, Canadian Utilities Limited, Bell Communications, IGM Financials, are all of the top 18 holdings that, as part of XDIV, you get exposure to. Here's the breakdown of those exposure by the market sector. The majority of exposure, about 50% of it, is to financials, followed by the other 20% or so to energy. And lastly, utilities accounts for around 16%. And you also have some exposure to communication and consumer discretionary and materials in there, though it's not as widely exposed to them. Our next holding that we would recommend and categorize here based on its fees, MER, is VDY, or Vanguard FTSE Canadian High Dividend Yield Index ETF. With VDY, you have a management expense ratio of 0.22%, so almost double the fee of what you saw for XDIV. However, what's really worthwhile mentioning here is two things, I would say. The first one is the fact that this fund has been around a lot longer than XDIV. It was incepted back in November of 2012, so at least about around that 4 to 5 years earlier. And on top of that, because of that, it has a very high asset under management. The other thing that I would like to bring to your attention is the fact that in terms of the number of holdings that you get exposure to through VDY, you're looking at 56 different Canadian stocks. Unlike XDIV, which you only have exposure to 18 different companies. So here, through the VDY, you have a much larger basket of Canadian dividend paying stocks, hence a little bit more diversification. VDY does pay its dividends also on a monthly basis. And if you look at its past returns, the 3-year annualized return here is at 16.4%, 5 years annual return of 8.6%. Because this fund has been around for a long time, that's why you also have its 10-year annualized return. Over the past 10 years, on average, every year, this fund has returned 8.3%. And lastly, the return for this fund based on market price since its inception is average annually 8.6%, which is quite decent for a dividend-paying ETF in Canada. Looking further, we're going to take a look at the different holdings that this fund gives you exposure to. If you're looking mainly at companies including Canadian banks, Royal Bank of Canada, Toronto Dominion Bank, Enbridge, Canadian Natural Resources, Bank of Montreal, Bank of Nova Scotia, Bell Canada Communications, Suncor Energy. These are among the top 10 holdings, along with TC Energy and Canadian Imperial Bank of Commerce. But if you're interested to see the entire holdings, you can simply download the file and it gives you the entire breakdown. What it essentially gives you exposure to by the market sector is mainly to financials. Here you have even more exposure to financials sector. Close to 54% of your exposure is to financials and the banks and alike. Then we have high exposure to energy at 28%. And then following that, we have exposure to telecommunications, utilities, consumer discretionary, basic materials, industrials, and real estate. Though I must say your exposure to industrials and real estate are very minuscule and not really anywhere close to what the exposure you get to the financials, energy, and telecommunications that you saw earlier. Our third pick here is XEI, iShares S&P Toronto Stock Exchange Composite High Dividend Index ETF. XEI has a similar fee to that of VDY. It has also the fee of 0.22% MER. With XEI, it has its inception going back to 2011. It has been around quite some time as well, even before that of VDY. It goes back to April 12th of that year. It does pay its distributions on a monthly basis, allows kind of offers that dividend reinvestment plan. Here you get even exposure to higher number of Canadian dividend paying stocks, to 75 of them, in fact, even more exposure and more diversification. If you look at its return over different time periods, the 3-year annualized return is at 17.5%, quite decent percentage. 5-year annualized return of 8.3%, 10 years annualized return of 6.7%. And its annualized return since its own inception is 6.5%. Looking at the specific holdings here, if the top one here is to Bell Communications. Following that, we have TC Energy, Enbridge, Canadian Natural Resources, TELUS, Toronto Dominion Bank, Royal Bank of Canada, Fortis, Suncor, and Bank of Montreal. These are your top 10 holdings. But if you're interested to see the entire list, we go through it. You see the other holdings that we have here as part of XEI. Definitely, because here you get exposure to 75 different companies. You see a lot more names of different Canadian companies that we've not had exposure to in the other ETFs that we've talked about. You might be asking, how's the market exposure for XEI, given that you have 75 different businesses? Here, you are getting a little bit more balanced exposure to the top 3 market sectors. Before, our top 3 market sectors were accounting for a huge exposure, and mainly tilted towards the top 1, which accounted for almost 50% or so of the exposure here. The top market sector is energy, which gets exposure around 29%. The second one is financial, almost at 29%. And the third one is utilities, close to 18%. Following that, you have also exposure to communication, real estate. Real estate here is getting a lot more exposure than the other ones, close to 6%. Then we have material, consumer, discretionary, industrials, and healthcare. Those are the market sector exposure that we have for XEI. Moving on, we are looking at ZDV offered by BMO Canadian Dividend ETF, ticker symbol ZDV, does pay a dividend on a monthly basis. It has a management expense ratio of 0.39% and an annualized distribution yield of 4.5%. Speaking of dividends, just want to quickly mention that for XDIV that we saw first, it has a distribution yielding around 4.2% annually. For VDY, its distribution yield hovers around 4.8%. And lastly, for XEI, it has an annual yielding around 4.9%. It's worthwhile mentioning that for ZDV, you are looking at its past return annualized, the past three-year annualized return of 15%, 5 years annualized return of 7%, and 10-year annualized return of close to 6%. If you look at its different holdings, the biggest holding here is Enbridge. Following that, we have Bank of Nova Scotia, Royal Bank, Bell Canada, Toronto Dominion Bank, Canadian Imperial Bank of Commerce, Canadian Natural Resources, Manulife, and Canadian National Railway. These are alongside TELUS. These are the top 10 holdings for this fund. If you look at the entire holdings, you're looking at a much larger list here. Through ZDV, you're getting exposure to 52 different holdings. And if you look at its inception date for this fund, it was incepted back in October of 2011. So been around quite for some time. If you look at the holdings by market exposure and sector, you can see the biggest exposure is to financials sector. Following that, we have exposure to energy at close to 18 or 18.5%. Then we have communication services at about 10%. Utilities, industrials, materials, consumer staples, and consumer discretionary are the next big exposure by sector for this fund, ZDV. The next holding for us to review is iShares Canadian Select Dividend Index ETF with ticker symbol XDV. With XDV, you are getting exposure to 30 different Canadian holdings. It does pay its dividend distribution on a monthly basis, and it was have its inception going back all the way to December of 2005. So it's been around quite some time. Its return, 3-year annualized, is at 14.6%, 5 years annualized return of 6.8%, 10 years annualized return of 6.4%, and annualized return since its inception, which was quite some time ago, back in 2005, is at 6%. Let us take a quick look at the specific details here on dividend yield. The distribution yield for this fund is at 4.35%. Once again, this is with ticker symbol XDV. With XDV, it has though a much higher fee at 0.55%. And if you look at its holdings, look at its entire list of holdings. The top ones include Canadian Tire, Bank of Montreal, Royal Bank of Canada, Bank of Nova Scotia, Bell Canada, TC Energy, National Bank of Canada, Toronto Dominion Bank, and Canadian Imperial Bank of Commerce, alongside Sun Life Financial at the top 10. And the list continues on with the rest of these holdings that I'm showing here on the screen. As for the exposure breakdown, your biggest exposure is to financial sector at 51%. Following that, we have utilities, communications, consumer discretionary, energy, materials, consumer staples, and industrials. And lastly, we have iShares S&P Toronto Stock Exchange Canadian Dividend Aristocrat Index ETF, ticker symbol CDZ, which has the highest fee compared to the rest of the ETFs that we've talked about. Here through CDZ, it has its common inception date back in 2006, September. It does pay its dividend distributions on a monthly basis, but you get exposure to one of the largest number of holdings into one fund alone. You have 91 different Canadian companies all grouped together into this fund, with a distribution yielding annually at 3.9%. Let us take a look at the fee though. It's at a whopping 0.66%. Although it may not be as high when you compare it to that of the mutual funds that hover around 2 to 3% in fee, here still when you compare those to that of the XDIV, VDY, or XEI that we talked about earlier on, this is almost 3 times, or sometimes even anywhere between 3 to 5 times higher in terms of fees. Something for you to keep in mind. The top holdings here include Aecon Group, Great-West Life, Fiera Capital, Chartwell Retirement, Residence, TC Energy, Bell Canada, Power Corporation, Enbridge, Canadian Imperial Bank of Commerce, and Bank of Nova Scotia. Keep in mind, here you get exposure to 91 different Canadian businesses. Hence, the list is a lot more extensive and a lot more exposure to different type of businesses that you may not typically invest in yourselves. So really good in terms of diversification if you would like to spread your risk and have more exposure to different type of businesses in Canada. Looking at that by market exposure breakdown, Biggest exposure is to financials at 29%. Following that, we have industrials, energy, real estate, utilities, materials, communication, consumer staples, consumer discretionary, and lastly, healthcare. I've gone ahead and done a head-to-head comparison of these funds. However, I've picked only the top 4 which have the lowest fee, the first 4 that we reviewed, because I didn't want to go for a fund that had quite a bit of a higher fee. These are the ones that if I were to personally invest in a high dividend paying ETF in Canada, would consider. So we have XDIV, VDY, XEI, and ZDV. And we are looking at the performance of them based on their own unique inceptions. Keep in mind, these funds have different inceptions, so it may not be quite as fair to compare them that way, but just out of curiosity, if you look at them based on their unique inceptions, the one that had the best return was VDY in this case, the orange one, with a whopping cumulative 120% return since its own inception. And then the next one with a higher cumulative return was the third one here on our list, which is XEI, iShares Toronto Stock Exchange Composite High Dividend Index ETF. However, if you look at them based on their common inception date, so if we assume which one has the latest inception date and we start that for all of them, and if you look at it since then, the one with the best performance, we have almost a tie, I would say. We do have a tie between XDIV at 57.7 or 8%, and the other one is also 57%, almost 57.1%, very, very close at around that, which is VDY. And probably the worst performance in this case was belonging, in fact, to the last one, which is ZDV, BMO Canadian Dividend ETF, which had a cumulative return of 43%. We can take a look at it more closely, though, at different time horizon. For example, in the past 1 year, the worst performing one was VDY, down 9%, and the best performing one in this case was the XDIV, which just shy of 1% positive return. 3-year annualized return, the best performance was at belonging to our third pick here, which is XEI, at close to 17.5%. But following that, it's almost a tie between XDIV and VDY. Well, as I pointed out, all of these 6 different ETFs that we reviewed and talked about are really high quality ones that could be good choices for investors who may not have the time to really do extensive research to pick and choose different stocks and rather want to get exposure to a basket of high quality Canadian businesses, and in the meantime collect a dividend income every single month. These would be good choices for you to consider. For me personally, I'm mainly invested in VDY, Vanguard FTSE Canadian High Dividend Yield Index ETF. At one point, I was also invested in XDIV, but given that these funds are very much similar, so personally, I don't think you want to have funds and investments in multiple of them. I guess at the end of the day, my recommendation is if you are going to buy and invest in Canadian dividend paying stocks through an ETF, just pick one of these ones because they are very much having a lot of overlaps. So it doesn't make sense for you to own and hold XDIV, VDY, XEI at the same time. It kind of would be redundant and not the most efficient way of doing it. For me personally, as I indicated, I went with VDY. At the time, it was a number of consideration. One being its low fee, although it doesn't have as low of a fee as XDIV. But the main difference between XDIV and VDY for me was that with XDIV, I was getting only exposure to a handful of Canadian businesses, and I didn't feel like it's diversified enough for my liking. Whereas with VDY, I'm getting exposure to 56 different businesses, and I find it a lot more diversified, has been around as well for a lot longer than XDIV. That was another real reason that I opted for VDY. And its fee, I find, still quite reasonable at the level that it is with its management expense ratio. Let me know which Canadian stock or ETF you are invested in. I would love to hear from you. So leave me a comment down below and let me know what you think. And if you haven't done that already, I would love it if you follow me on Blossom Social. You can definitely follow along with the link provided in the video description and follow my journey, all my buys and sells in the market, almost on a real-time basis there. And of course, subscribe to Moementum channel. Here on Moementum Finance, we post weekly videos about investing, including investing in dividend stocks, growth stocks, penny stocks. We also talk about ways to reach financial freedom. Thank you, and I hope to see you all next time.